Okay, let's look at this problem 211, which has three separate questions for us. Here's what they say. They say, suppose that in 2013, Global, that's a company, and we're going to be looking at its financial information in a moment. Global launched an aggressive marketing campaign that boosts sales by 15%. However, their operating margin fell from 5.7% to 4.5%. Suppose they have no other income, interest expense remains unchanged, and taxes are the same percentage of pre-tax as in 2012. What's Global's EBIT, or EBIT, which is earnings before interest and taxes, in 2013? Well, let's go look at the financial information. Okay, and what they did is they presented us with some balance sheet information. Now, I know you can't see all of it on the screen, but for this part of the problem, it won't matter. Okay, so we've got assets on one side, liabilities on the other. And then down below, they gave us the income statement. Okay, and we know that sales growth was up and operating income was down, and EBIT is interest before interest and taxes. We're not changing too much on the balance sheet here, so I think we can just really focus on the numbers here. So here's what we knew. In 2009, we had total sales of 186.7. Now that's in cell C34. So if I jump back to our problem, by the way, that's on a different page, I can slide this down and I can say, well, what's the growth rate in sales? Well, they gave it to us at 15%. And they gave us the new operating margin at 4.5%. So let's first compute what our net change in sales are. And we get 214.71. Well, how did we get that? Well, we go take last year's sales, that was in cell C34 on the financial page, which is right here, C34. So 186.7. Okay? And I'm looking here, we multiply that times 1 plus the value in D12, the 15%. So that's our new incremental sales. Or not incremental, that's our new sales. Next thing we want to figure out is what's earnings before interest and taxes. And let's look at this formula. Okay, now what we're going to do is we're going to take D14 times D13. Okay, D14 is new sales, and we're going to multiply it times our new operating margin. That's how we could derive earnings before interest and taxes. Okay, next we're going to answer part B, which says, what's Global's income in 2013? All right, well, here's what we know. We already know interest before incomes and taxes because we're able to calculate what the increase in sales were and then what the margin was on those sales to come up with 9.66. We know from what they told us there's no other income. Interest expense remains unchanged. Now let's go look at that. Okay, in 2009 we see right there that the interest expense was 7.7. So we throw in our 7.7. Now if we just run the math now, which is add those three lines, we have pre-tax income of 1.96. Taxes remain, I think, at the same tax rate. Well, we've got to go find the tax rate, which basically says, well, let's go look at it. Okay, now we could calculate the tax rate if we wanted to, and I'll just do it right here. They actually did it in the formula, but we'll do it this way. We'll take taxes, which is 0.7, and divide it by pre-tax income. What does that give us? 26%. Now, it's showing a negative only because they show the taxes is a negative number. So what I would do is just flip the sign, just put a minus in front of one of those. So I've got essentially 26% is my tax rate amount. Okay, now if we click on this formula, they actually do the same calculation that I just did on the other page, but just to show you that that's the right amount, I'll take the pre-tax income of 1.96 and multiply it times 2.59, I think was the right number. And you see that I am getting that same 0.51 here. Let me format it so you can see it's looks exactly the same. And of course, we show it as a negative if we're just going to sum from above, which is what we're doing here, D19 plus D20. So we're showing taxes as being an outflow. And the end result is we can compute net income of 1.45. Okay. Okay, then on part C it says if Global's PE ratio and number of shares outstanding remains unchanged, what's its share price in 2013? Okay, so if we calculate to the price to earnings ratio, let me restate that. If we're given the price to earnings of 25.2, okay, then we can compute the share price. And how we would do that is we would take the net income and then multiply it by the price to earnings. Now, multiplying the net income times the price earnings, it gives you the share price in total. We then have to divide it by 3.6. Okay, and let me explain why we're dividing it by 3.6. Cell D22 is the price to earnings ratio. Cell D21 is our total net income. That gives us net income times the total price PE ratio. So that's the total earnings multiplied, if you want to think about it, the total value of the capitalization of the company. But then we've got to figure out how many shares were actually outstanding to compute it on a per share basis. Now, if we jump over here, and we wanted to compute the number of shares outstanding, and I just went ahead and typed this label in here, you would take the net income and divide it by earnings per share. Okay, and I come up with 3.59, which rounds to about 3.6, and that's where that 3.6 is coming in down here to break this down to the 2013 share price.